Well, you will have to say this is not a hawkish pause. I mean, there is no reiteration of OMO sales in any significant manner. Yes, there is a reiteration that the Reserve Bank will not rest till you get to, till CPI aligns to 4%. But my sense is that there are two very big positives in this policy. One, the growth forecast has been upped, not as expected to 6.7 or 8, but to 7%. My one eye was on the Nifty to see whether Mount 21,000 is conquered. It's still dithering at that point, but there is everything in this policy to just help the index over. Okay, there we are. As I speak, 21,000 scaled, and that's because a bit of a buck up is given by the Reserve Bank. Instead of sounding scared of the high growth and the potential inflation that it may lead, there was some fear in some quarters. There is no such extra fear over inflation that the Reserve Bank has expressed. It's also been more optimistic of growth than the average economist on the street, and the market is bucked up. The Reserve Bank is usually a conservative force. If the conservative force has taken GDP forecast to 7%, we ought to take it very seriously, and that's what the street is doing at this point in time. 21,000, I hope there are enough bells and whistles and flowers that our production team is ready with to celebrate this achievement, 21,000. But we have a policy to analyze. Ritu Singh is with me, and so are our guests, the Managing Director of State Bank of India, Mr. Setty. We also have Economist Kaushik and of Deutsche Bank, and Upasna of Kotak. We also have Rajeev Radhakrishnan, the CIO at fixed income at SBI mutual fund. Mr. Setty, let me first come to you. The governor has given a very optimistic forecast for growth itself. What are your key takeaways? Do you think you should expect higher credit growth this year?
Yeah, good morning, Lata. I think it is indeed an optimistic announcement, and I think there are quite a few positives, both in terms of the growth estimates, moderating inflation, though the governor sounded concerned on the vegetable inflation, which may, be higher. A few positives, both on the growth side and moderating inflation, and the softening of the commodities, is also, I think, positive to economy, and the economic buoyancy is also visible in the second half. We hope that the growth rate in the loans will continue as we expected. This second half is generally a busy season for credit growth. The festive season, marriage season, they all spur the consumer spending, and we see the increased capacity utilization, as the governor mentioned in his speech. And hopefully we'll see definitely much larger credit growth in the system as well as in our bank. And a few other things also, of course, the measures which announced by the governor are extremely positive, Lata, in terms of making the reversal of liquidity facilities, both weekends and holidays. I think this long-standing demand from the industry, we are glad that it has been implemented, though it will be reviewed after 6 months based on probably they would like to see how best it is being utilized. I think it's definitely eases the liquidity management at the banks and the financial institutions.
Okay. Actually, that was going to be my next question to you, Mr. Setty. How do you think it will impact? If you will see, I mean, if banks are reassured that they can, pull out liquidity from SDF and MSF, or, extra liquidity even during the weekend, are you expecting that the call rates will come down? Is that a possibility?
Yeah, see, I think there is some amount of proactive borrowing which happens in the market, to take care of the weekend requirements. As you know, most of the RTGS, NEFT fund transfer is 24/7 now. And to take care of that, SDF is funded. The additional liquidity is mobilized over in anticipation of the liquidity requirement for the weekends. That concern will not be available because we can always access the MSF now in case of requirement. And if any excess liquidity is there, that can be parked in SDF even during the weekends. I think it's a better management of liquidity which is going to be available to the banks, and it's extremely positive in my view.
Eased. Okay. Rajeev, what's your sense? Are we going to see any impact on the yields at all, especially shorter-term yields?
Yeah, a lot depends upon how the RBI manages the interbank liquidity today. Because over the last 2 months, even though the rates have the policy rate has remained at 6.5, the effective operating rate has been the MSF. So a lot depends on how that interbank liquidity evolves and where the overnight rates eventually settle down. So we don't really see any immediate visibility that the overnight rates are going to settle back closer to the repo rate. So to that extent, given that there is seasonality also involved, you could potentially see the shorter end of the money market curve staying elevated for a while. But yeah, finally, it depends upon where the effective operating rate settles down.
Okay. Got that. Upasna, I want your view on call rate as well, and near term, whether shorter term money gets cheaper, but more importantly, your reaction to the 7% GDP. Now, do you think you're going to see a series of upgrades of GDP in the market?
Lata, we had recently revised up our GDP numbers to 6.8%. So we'll reserve any change at the moment. Of course, somewhere between 6.8 to 6.9 is where I was expecting RBI's number as well. So this is slightly higher than what we were expecting. But I think we'll have to wait and watch. We'll have to see how the high frequency data in the next quarter also pans out for us to have a much more firmer call for the fourth quarter. Third quarter clearly looks to be doing good. And if this was to continue, then probably RBI's readings will be we'll be closer to RBI's reading. So there was always an upside to the 6.8 that we were looking at, but we will wait and act based on the data that we get. On the call rates, I think we have to look at overall liquidity situation over the next 2 to 3 weeks. We have now the advanced taxes, then the GST related outflows. Yes, the government has been spending, but at the same time, we don't really expect liquidity to remain as benign as where it is, closer to neutral. It will tighten significantly in the next 2 weeks. The net impact of government spending will clearly determine how deficit it gets. So the rates, I think, will continue to remain closer to the upper end of the corridor for now. Next quarter is where we see scope for significant easing. It could be coming because of more government spending, and at the same time, also because of FPI flows picking up pace. Both of this could result in liquidity easing. And of course, what recently RBI has announced today, the MSF and the SDF related unwinding. I think that part is definitely positive, but we'll have to see how that really impacts markets on a more sustainable basis.
Kaushik, not at all the hawkish stance that some were expecting, the pause as expected. The GDP hike, almost 7%, I think nobody had factored in that. And I suppose the markets are going to be happy with the SDF and the MSF windows remaining open on weekdays and holidays.
So I think, Ritu, no surprise was the surprise element in this policy. Sometimes, it's good to have no surprises, and it came that way. So that's a good thing. I would like to make a few points. And the last paragraph, if you heard the last line, what Governor mentioned, one thing which he suggested was that, at this point of time, you have to be very careful with any kind of new announcement or decision, because, there is a risk of over-tightening as well, which could impact the economy. So this is the first time I'm hearing after a long time where RBI is trying to put a balanced narrative that, okay, we need to be vigilant. If inflation goes up, we need to be proactively, doing something. But at the same time, if we do too much, that can have impact on growth going forward. So that particular sentence caught my attention. And, we'll analyze that later, how to read that. If RBI has put a line like that in the statement, it has to have some meaning. So I think they're getting also a little bit cautious about the global turn that is happening in the market pricing for US and the Europe, advanced countries' interest rate expectations for 2024. So India also needs to be aligned to that. So I guess the fear of incremental rate hikes have gone with inflation forecast remaining unchanged. The 7% forecast is looking a bit optimistic. It can happen, but remember that in February end, when we get the October-December GDP number, there'll be a host of revisions done to the previous quarter's data. So we have to analyze that and see how the base changes for the previous year. And we could achieve 7%. But then the narrative is, despite RBI's 300 basis points rate hike in this financial year, last financial year, this year there's hardly been any kind of reduction in growth from 7.2. If you're achieving 7%, there has been no incremental slowdown to that extent. So then you'd expect those rate hikes to have impact going forward in FY25 and beyond. So RBI has given probably 6.7 or something for next year, or 6.5. My guess is growth could be lower in the next financial year to 6.3 from if we achieve 7% this year.
Yeah, but like Lata was saying, RBI is one of the more conservative of the lot, and then giving the 7% number is quite good news. But Mr. Setty, coming back to you on this connected lending measure that the governor had announced, how do you read this? I mean, they're talking about coming out with a framework on connected lending for all regulated entities. And earlier, the governor had sounded a cautious note, on the NBFC, bank lending to NBFC, for banks to be watchful of, how much NBFCs are borrowing from all other banks. Do you think it's linked to that? Are you expecting stricter measures on that front? Or, what's your reading of these connected lending measures?
So let's wait and watch, Ritu. I mean, we'll have to see what is actually coming out in that. But there is definitely a concern both in the regulator's mind as well as the banks in terms of the systemic risk which may come out if we do not strengthen our underwriting process, both at the bank levels as well as NBFC level, because there is so much dependence of NBFCs on the bank lending. And that continues to be one of the largest sectors to which banks currently lend. So it is important that both banks as well as NBFCs review their processes, underwriting standards, and the way we manage our credit. I think probably this could be the backdrop which earlier also was expressed and now would form the basis of the norms which are going to come out. I think we'll have to see what is there in the direction. And hopefully, I think probably it would be to address the concerns which are, leading to a kind of systemic risk if not addressed.
Mr. Setty, so you think that loans could to NBFCs could already get rationed because of the very presence of these two words? I think Ritu is absolutely right. This is the most important thing that seems to have come on the regulatory side in terms of just a caution and a framework that is expected. Will you, in advance, lend less to NBFCs?
No, I think this is not about more or less lending to NBFCs. It is about, the way we lend to them, the assessment of the credit requirement of NBFCs. And more importantly, I think earlier the governor expressed, and as well as we also have been concerned that most of these NBFCs borrow from large number of banks. Probably that needs to be a little more cautiously looked at. Large number of lenders means, the monitoring standards probably get weakened. I think we have been saying that there should be a consolidation of number of lenders from where the NBFCs borrow, either NBFCs or MFIs. It is not to ration the credit available to them. Of course, the better managed and better governed NBFCs, MFIs will continue to get the credit support from the banks. I don't think it will lead to any rationing of the credit.
Okay. Well, we'll let you go, Mr. Setty, to ponder over what they have said and touch base with you and other SBI officials later in the day. But certainly, this is something to watch out for in terms of a connected lending framework that's expected. Let me also get back to the Economist on this very important point that Kaushik has brought, that the governor is also cautioned about possible over-tightening. And as he says, this is the first time in many policies that we have heard that. Upasna, your thoughts? And does this policy therefore qualify as a dovish pause?
Lata, two things. While I think the governor has very beautifully balanced the entire, guidance that they've provided for. One is their emphasis on inflation, 4% inflation being the goalpost that they haven't deviated from. And at the same time, clearly, what they're emphasizing on is that somewhere over tightening is it may prove to be detrimental. So we'll have to be very cautious and agile. I think somewhere they've tried to balance the two things together. And that is important to keep in mind because effectively we have seen a stealth tightening of rates of quarter point because of very tight liquidity. And I think that is where we might see some moderation in rates coming down. So while repo rate remains where it is, we may see a small amount of next quarter onwards easing on the market rates, money market rates, somewhere a little lower than the MSF rates. And that in itself could set the floor overall for the next year. But I still believe that there is no point in discussing about a possibility of a rate cut anytime soon because growth does remain robust and RBI is sounding extremely positive on that front. So I would still consider this as a fairly balanced policy, trying to evaluate on both sides more equally rather than taking it a step forward to say it's dovish.
Okay. Ritu?
Well, let me get back to you. Mr. Radhakrishnan, again, the liquidity-related measures, is there anything else that the markets are really watching out for? That threat of OMO bond sales, no mention of that at all in this policy again. In fact, the governor has said, the window will remain open on the weekends as well to facilitate easier liquidity. Was there anything else you were watching out for? I think, Mr. Radhakrishnan, you're on mute.
Yeah, sorry. Yeah. So the last two policy announcements, we did have certain unanticipated measures to address liquidity. So we had the ICRR and then subsequently in the previous policy, you had the threat of OMOs. So I think this time the market was probably really looking at how the governor would address that OMO threat. And I think they have tried to give reasons as to why the OMO was not conducted over the last couple of months, because there was anyway a drawdown of liquidity due to seasonality as well as buildup of government balances. So that context remains, I think going forward as well, because as you get into the next year, if we see large capital flows continuing, like in the last couple of months, we have again seen resumption of portfolio flows. So overall, the context is that RBI's actions on liquidity would be a function of to what extent the capital flows come in and to what extent that adds to interbank liquidity. So I think the single, going forward, what one needs to watch is from the operational perspective, would the RBI be comfortable running the system at 675 or as liquidity starts to come back at some point in the beginning of the year, would they allow the overnight rates to drift back towards 6.5? So I think that is something that probably would be necessary to watch incrementally. For the time being, yes, the immediate threat of OMOs, I think, has been...
Rajeev.
Yeah.
No, that was my question to you. Are you expecting a drift lower towards 6.5, going by the overall tone of what the governor is saying?
A bit premature. Honestly, no, I haven't got that sense because I think it was quite balanced on both the sides, right? The governor did mention about the risk of over-tightening and again the risk of being swayed by a few months of good data. I believe we've not really got a very clear clarity as to whether they would allow the drift back towards 6.5.
All right. Okay, then we will leave it at that. Rajeev, thank you very much indeed for staying on with us through the policy. Kaushik, I wanted to ask you the same question that we asked Upasna, and the point you brought out. Would you say this is overall a dovish pause now? And therefore, we can see some kind of relaxation of yields in the call market. See, they've spoken about this reversal of liquidity over in the weekend as well. They've spoken about higher dangers of higher tightening, over tightening. Does it prepare the ground for probably a neutral stance in the next policy?
So Lata, I would see it on the margin as a bit dovish because, if you had growth at 7%, forecast being raised, inflation, you're holding it at 5.4. On the margin, growth forecast has been raised, so you would have expected something more hawkish. So on balance, if you cut all the noise, and this sentence has been put in, RBI never will put a sentence without having any implication for the future. So I'm not saying rate cuts are going to happen anytime soon, but this is one way, the first time that they have put it, to bring in a bit of caution on the other side as well, that are we tightening too much, higher for longer? I'll just point out to you one thing, that in the last 20 years, the period between the end of a rate hike cycle and the start of a cut cycle, the maximum that RBI has held on to in 2 episodes have been 11 months. So the last rate hike was February. So by January, February, by that metric, RBI should be easing rates. This time the cycle is different because the Fed is expected to cut a little longer than their own peak of the rate hike cycle. So if they possibly cut in June or August, that will be more than 11 months, like 16 to 18 months. So keeping this rate higher for longer, will it impact growth? Maybe it didn't impact this year. We probably would be close to 7% like RBI has forecasted. But is there a risk for FY25? And monetary policy is always forward-looking. So you have to take a call right now, thinking about the next 3-4 quarters down the line, how credit growth will look, how general growth and inflation would look. So if you get a sense that not right now, but 4 quarters down the line, inflation would be close to 4% or between 4.5%, growth would be slowing down, credit growth would be slowing down because of the risk weights that have been raised. You have to start preparing the market slowly by putting in some sentence here and there. So I think that move has been made in this policy December. It doesn't change the big picture as of now, but going forward, incrementally more could be added if inflation comes down.
Okay, Mr. Ashwini Kumar Tewari, Managing Director at State Bank of India, is also with us. Mr. Tewari, thanks very much for joining us here. Your quick takeaways, liquidity management gets easier for you. How does life change? And what did you make of that connected lending framework that RBI is going to announce?
So the connected lending framework, Ritu, we'll have to see the actual details of what is there in that. But clearly, the RBI is a little worried about the same customer borrowing from banks, from NBFCs, from various other entities as well. And therefore, the need for a common regulation, or how do you track across? That's my sense. But I need to see the actual details of the announcement or the framework before I can comment in greater detail on that.
But Mr. Tewari, do you think this is more linked to bank lending to NBFCs? That is something that the governor has pointed to before? Or is it more linked to the digital lending, which has also been heating up? So, what do you think he's referencing to?
I don't know for sure, because clearly the bank lending to NBFCs has gone up, which has been commented upon earlier, and the risk weights have also been increased. But the major issue in the bank lending to NBFCs and further NBFCs lending onwards is the monitoring of that lending, because most NBFCs are borrowing from a very large number of banks, even for small amounts, for 30, 40, 50 banks. And there is very little coordination which the NBFCs want between the banks to see whether the same set of assets are being shared across, etc. That is the difficult part. So as long as that part is controlled by any of the measures which is announced, I think that would be a good thing. However, I'm not very sure whether that is being referred to, or is it the NBFC lending to, or digital lending referred to. I'm not sure.
Okay, so Mr. Tewari, thank you for joining us. Would you say the overall impact will be, what the governor said is that they're going to put out a framework for this connected lending. Until that comes, is there a likelihood that all of you will slow down a bit on both NBFC and unsecured loans?
So there is no question of as such slowing down or something. We are cognizant of the risk weights which have been increased earlier and the impact that has in terms of rates. And the important thing is that all banks should have internal limits, as we do, on how much we will lend to NBFCs, how much unsecured lending will there be. And as long as we are within those caps, and as long as the overall quality of that lending stays good, I don't think we are going to slow down. For good quality credit, whether it's the NBFCs or otherwise, or in unsecured, in our case, it is largely salary driven. I don't think we are going to stop or slow down, etc. We will be cognizant of the risk as they are and recognize them.
If you were an NBFC, how would you read this statement? I mean, we will get NBFC companies later on in the show, but would you say that the governor is just raising the bar a little more in terms of the availability of loans for them?
As an NBFC, I'm already worried because of the previous announcements which have been made. So I would like to read this first in detail, because clearly if the cost of credit goes up for the NBFCs and further tightening happens in any manner, that would make it difficult for them to get funding cheaply and pass it on to the other segments which they are lending to. But clearly the growth shows that the economy has a lot of capacity now to absorb credit. And the RBI's endeavor, I think, is only to make sure that it is graded and it is in a calibrated manner, not in a spurt or a peak, which is what they want to control. So we'll see about the details of the announcement and then take a call.
Mr. Tewari, if it helps, let me just read, because now the speech is on the website, so I can read out that line to you if it is any clearer. The extent guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by regulated entities. Is it sounding like strict?
So see, the connected lending guidelines, as mentioned, were already in place. As far as what tightening will they make it or what clarity they will bring, as I said, we have to look at the actual policy framework when it comes out. I really can't speculate on the governor's words as to what he means unless I look at the details of it.
Yeah. No, we will of course have occasion to ask him in the press conference what exactly this means, and maybe we will get more clarity over there. But overall, have rate hikes been passed on, or do you think there is a little more? I mean, if I'm a home loan buyer, should I be prepared for a little more in terms of rate hike, or have we peaked?
No, I don't think any more increase in rate hikes is being considered by us at all. Of course, on the corporate side, there is always this competition which happens and which kind of brings down the overall rates for people. But from a lower base earlier, prior to the rate hikes, that has also gone up. So in that sense, the linkage to the monetary transmission, which the governor also mentioned, has happened. I don't see any further increases either in home loans or any other products which we have, except for the risk weights which were increased some time back, where some increase might happen. Other than that, I don't see anything happening in the terms of rate hikes.
Oh, okay. Well, actually, as of now, the bond yields have gone down a bit. It was 7.24 when the governor finished his speech, and now it is 7.23 on the 10-year. So clearly the market is reading this as positive. The markets have sulked a bit. I was expecting 21,000 and more gangbusters because of the Reserve Bank backing that 7% number. That has not happened. Mr. Tewari, thank you very much, sir, for joining us with your first thoughts. So we will get back to the SBI biggies after the press conference as well. Upasna, I want to ask you the same question I asked Kaushik. No, the overall impression seems to be that the Reserve Bank is done with tightening. No, once again, brandishing of OMO. In fact, a statement that we must not go to the risk of over-tightening, and a very big revision in growth as well, better than all the markets. So is this a dovish policy? Would that be your statement?
Lata, I'll again say I'm not treating this as really dovish. A more balanced word is what I'll go with. I think
Hello, I can't hear. Can't hear. Here.
If I was to read the resolution, am I audible, Lata?
Yes, now I can. Go ahead, please.
Yeah, so if I just read the resolution's last paragraph, that is nowhere sounding any soft. It is actually balancing it out and talking about their focus on 4% being retained, and they have to ensure that the disinflationary trends are sustained. Also, when we talk about the withdrawal of accommodation stance being changed, because clearly nobody is really expecting a rate cut in the near term. I think that's one thing we have to be clear on. The only change that could come about at any point in time is about the drop in the stance that at the moment what they have. And that too, I don't see that happen before probably the middle of next year. The reason I'm saying is because inflation is still a problem. And till that doesn't happen, while no more tightening has to happen, but no more easing is also required. So I think they'll still continue to be on a balanced footing rather than dovish, because that will probably undo the kind of efforts that they have taken over the last few months.
Okay, got that. The absolute middle of the road policy, neither hawkish nor dovish is your statement. And I think that statement has to be read that way. Policymakers have to be mindful of the risk of being carried away by a few months of good data or by the fact that CPI inflation is coming within target range. They also have to be mindful of the risk of over-tightening. If you read it together, then perhaps it looks more middle of the round, but the fact that for the first time he's speaking of over-tightening is a bit positive if you are a dove. Thank you very much, Kaushik, Upasna, Rajeev, Radhakrishnan, Mr. Tewari, for reading the fine print of the policy to us. Thank you very much, Ritu Singh, as well. The statement, the big takeaway from the governor's policy is that growth has been given a kind of a leg up by a conservative entity like the Reserve Bank, saying that this year's growth is going to be 7%. If I remember right, Shaumikanti Ghosh of SBI is the only one on the street with a growth forecast of 7%. Everyone is in the 6.7, 6.8 range. So this should be seen as, extremely bullish on that count. The bearish element, or maybe the cautious element, is only this word on connected lending and the fact that some overarching framework will come out from the Reserve Bank. Will that make it a little more difficult for banks and NBFCs to lend to unsecured quarters? We will have to see, because that has macro implications if there is lesser unsecured loans and lesser money going to the NBFCs. But that will depend on the fine print, and it will also depend on what the governor tells us. Otherwise, it looks like a very neutral pause by the Reserve Bank, neither this way or that, and the bond markets have reacted with bullishness. You have actually seen bond prices rise. On that note, thank you very much for watching this special edition of the Monetary Policy. We will be back with the governor's press conference.